Hello and welcome back to The Note. What a difference a year can make. 12 months ago, when Mark Carney was appointed the new governor of the Bank of England, he was on a rescue mission. People wanted to know how he could save the UK from an incipient economic crisis. Now it looks more as though his job is to manage prosperity. Growth has gone much better than anybody expected over the last 12 months. And now maybe the Bank of England may even have to be the first major central bank to start raising rates in the new year. With me now to discuss this is the CEO of Longview Economics here in London, Chris Watling. Chris, thanks for joining me once again.
Yeah.
Let's take a look at one of the many measures you've produced which suggests that there is a real level of optimism in the UK economy now that we haven't seen in more than a decade. Take me through this chart.
Yeah, so here we're looking at the demand expectations for the service sector. Of course, 3/4 odd of the economy, a very significant part. And like actually a number of charts that we see on the manufacturing side as well, we're sort of back at 97, 98 highs and really looking quite impressive. Look like there's a lot of strength potentially coming through, a lot of momentum building in this economy.
And this is broadening out. This isn't just a question of the City of London across the river from us here. This is getting into the manufacturing sector now as well.
Exactly. It's broadening out. You're seeing the manufacturers sector's capex intentions look good. If you look across all regions, house prices in all regions are going up for 2 quarters in a row now. That's the first time since the crisis. And there are all sorts of indicators suggesting things are broadening in terms of the recovery, broadening across the country. And really some charts really quite high levels suggesting momentum's really quite good.
Now let's take a look at what that might mean for living standards. And you can see what there seems to have been quite a significant breakdown in the correlation here that vacancies are going up, which is encouraging, but average earnings are continuing to fall. Presumably that's going to have to reunite those two lines.
Well, that's right. We'd expect this correlation to re-come together again, if you like. It's broken down over the last year and a half. But typically, as you'd expect, if vacancy rates are going up and other signs of labour markets starting to tighten are also coming through, you'd expect the average earnings to start to improve and wages basically to start growing a little bit better than they have been.
Okay, now that's evidently good for living standards. It'll make people feel better, but it also presumably means inflationary pressure. Are you concerned now about an inflationary pressure going forward?
Yeah, I mean, it's not going to come running at us hard next year, but actually there's lots of capacity constraints starting to show their head. If you look at manufacturing capacity constraints or service sector capacity constraints or some of the labour market tightening indicators, they're all sort of in the early or middle stages of saying capacity starting to tighten up a bit in terms of output capacity and labour market capacity. And these are classic early indicators that inflation is going to start emerging on the horizon and will have to be dealt with at some stage.
Okay, now let's take a look at what this means for the dilemma for Mark Carney, who not so long ago was expected to be managing yet more alternative monetary policy. This is a chart that you've produced deriving what you see as the implicit market expectations of when we get the first rate hike.
That's right. This is derived off the short sterling curve, which tells us going forwards how the market's priced for interest rate hikes. And of course, the Bank of England's been suggesting 2016 or perhaps if you're optimistically interpret the Bank of England, late 2015 for the first hike. And really that's where the market is. We don't get above 0.5, above 50% chance of a 25 basis point hike until September 2015.
And a less than a 1 in 4 chance of any hike next year.
Less than 1 in 4, exactly.
Now the whole drift of what you're suggesting was, given that we're currently at an exceptionally easy level and you're predicting growing inflationary pressure, it must be that you would be making a call that the hike could come earlier than this.
Exactly. I mean, we've got to remember the bank's got to get, first of all, back to neutral before it can then start tightening. So there's a long old road all the way back to neutral interest rates given where we are today. So yeah, I think the bank probably needs to start putting up rates towards the end of next year, given the inflationary pressures that are starting to emerge, the momentum in the economy, the capacity constraints that are starting to emerge and the high level of output in some areas of the economy.
Okay, so very quickly in terms of asset allocation, that presumably means getting bullish on sterling, and given the amount of earnings that are foreign in FTSE stocks, relatively bearish on the FTSE. Is that fair?
Yeah, I mean, I think global equities will do well next year. The FTSE might lag. It depends on your currency location and so on. But in terms of sterling, I think sterling euro will do well. I think the same argument, similar sort of arguments can be made in the States for a rate hike at the end of next year. So sterling dollar may not have much strength from here, to be honest. I suspect we've probably seen near to the highs on sterling dollar, but certainly against the euro, I think sterling will do well, and the UK market in local currency terms might lag. In sterling terms, it's probably much of a muchness.
Okay, Chris, thank you very much indeed. So we're ending 2013 with some really quite good news for the UK economy. Given my normal role of spoil sport, obviously the bad news potentially is that it does look as though we might have a hawkish surprise coming up. While it's a hawkish surprise, which would be for very good reasons, whenever the market is surprised by something, you can have some very intriguing volatility while it works things out.